Most dropshipping stores don't fail because they pick the wrong products. They fail because outdated banking infrastructure bleeds their margins dry as they attempt to scale. This capital drain happens across three specific points: payment processor conversions, foreign transaction fees on ad spend, and supplier wire costs. This bar chart shows a store operating at a 15% net profit margin. But when that store is forced to convert international customer payments back into its home currency, it typically loses 3% of its revenue to exchange rate markups. That profit is now shrunk to 12%. That lost revenue represents more than a small fee. In terms of your actual bottom line, it equates to the destruction of 20%, or 1/5 of the store's total net profit. To solve this, you need to shift to a borderless treasury solution. Airwellix was designed specifically to handle these global e-commerce flows. Treating financial infrastructure as an afterthought is a silent killer. Controlling the flow of capital is as vital to your survival as customer acquisition. The first point of the triangle is Stripe's 2% currency conversion fee. This is triggered automatically whenever you settle foreign revenue into a single domestic bank account. You bypass this using like-for-like settlement. This allows you to collect and hold revenue in its original currency without triggering any exchange rates. Within the platform, you generate dedicated local banking details for your primary markets. You can instantly access a US routing number, a UK sort code, and an EU IBAN. This means a €1,000 customer payment lands natively in your Euro wallet. Because the money never changes currency, you bypass the Stripe conversion tax entirely. Isolating revenue into native currency buckets allows a standard storefront to operate with the financial structure of a true multinational entity. Now we look at the absolute largest variable cost in dropshipping: scaling international digital advertising campaigns across borders. Traditional corporate credit cards usually penalize international ad accounts by adding a 3% foreign transaction fee to every billing cycle. The solution is a virtual Visa card system. This allows you to create unlimited, multi-currency debit cards for different parts of your operation. You assign a specific virtual card to an ad account and bill it directly from the corresponding native currency balance. This reduces your foreign transaction fee to zero. There is a secondary benefit. On all US dollar ad spend, you receive 1.5% cashback, which routes directly back into your central treasury. Eliminating these penalties and capturing cashback allows your banking setup to generate surplus revenue rather than simply acting as an expense. The final side of the triangle involves transferring capital to your manufacturing partners and agents in China. The traditional SWIFT network often charges minimum wire fees of $45 and introduces unpredictable delays as money moves through intermediary banks. Avoid this using local transfer rails. By combining these with a CNAPS code, you route funds directly to local Chinese accounts. This secures the interbank rate with a fixed 0.5% markup, completely removing unpredictable lifting fees. Mastering these localized payment rails improves your supply chain velocity, providing a concrete competitive advantage in your logistics. High-volume multi-currency microtransactions can become an operational bottleneck when handled through manual bookkeeping. This is solved by natively integrating your accounts with software like Xero or QuickBooks. AI-driven reconciliation automatically tags and syncs global spend in the background. It categorizes your transactions without manual data entry. Unlike the high overhead of traditional business banking, the Explore tier has no monthly fees and requires no initial deposit to open. The final ROI is significant, removing the 2% payout tax, erasing 3% ad fees, and eliminating $45 wires. You keep thousands of dollars that would otherwise be lost to the banking system. Efficiently scaling a global business requires moving past traditional banking limitations and adopting a financial architecture built for cross-border commerce.